Welcome to The Explainer. Look, I want you to just forget everything you think you know about legacy automakers playing it safe. Forget it. Because today we're tearing right into Volkswagen's first half 2026 financials. There's blood in the water, there are absolute billions on the table, and honestly, the market is completely divided on this one. We're going to rapid fire through the data to find out exactly what is happening beneath the hood of this German titan. Let's kick things off with Section 1, the hook and overview. Just let the sheer scale of this number wash over you for a second. To understand the financials here, you really have to understand the beast. Volkswagen isn't just a car company anymore. It's a sprawling global empire that's navigating a spectacularly messy and, well, incredibly expensive transition from internal combustion to EVs. 158.1 billion euros in sales revenue just for the first 6 months of 2026. And what's wild here? That mammoth figure is basically flat year over year. It's a stark reminder of exactly why this market giant demands our absolute attention today. When a machine this big stalls or accelerates, the entire global market feels the shockwave. So the crucial point of this whole explainer is answering one single question. Is Volkswagen a classic value trap? You know, a sock that looks cheap on paper but is actually bleeding out from legacy inefficiencies? Or is it a coiled spring, packing immense kinetic energy in cash and new tech just waiting to explode upward? Let's figure out if this is a buy, sell, or hold for the focused investor. Moving right along to Section 2, catalysts for growth. Look, if you want massive shareholder value, you absolutely need catalysts. In Volkswagen, they've been making some highly aggressive, borderline ruthless moves on the chessboard lately to lock down their future. Back in April 2026, VW injected a fresh $1 billion with a B into US EV maker Rivian. This bumps their total equity interest up to a very commanding 15.9%. They aren't just trying to build EV tech in-house anymore. They're literally buying their way into the future architecture so they don't get left in the dust by agile startups. And immediately follow that up with this absolute monster of a cash windfall. VW agreed to sell 51% of their Everent subsidiary, the guys who handle their large engines and turbomachinery, to Bain Capital. They are expecting a massive 7.4 billion euro cash inflow from this leveraged buyout by the end of 2026. That is an enormous war chest being unlocked to fund this green transition. All right, let's look at the actual damage in Section 3, financial health breakdown. Because a war chest is really only useful if you aren't bleeding out somewhere else, right? Notice the divergence we're seeing here. If you look at the drop in vehicle sales, global deliveries to customers actually fell 6.3%, down to 4.1 million units. So unit volume is definitely shrinking. But then look over at the flat sales revenue. It stubbornly held the line at that 158.1 billion euros mark. What does that mean? It means despite shipping fewer cars, they extracted the exact same amount of cash. Now sure, it shows pricing power, but it also highlights some pretty negative mix effects and serious volume pressure in key markets like North America and Asia Pacific. And honestly, ouch is right. Sometimes you just have to amputate to save the patient. VW swallowed a brutal €500 million expense to abruptly kill off production of the ID.4 in Chattanooga, USA, mid-April 2026. Yep, a €500 million impairment hit just to wipe the slate completely clean and pivot to higher volume products that, actual humans want to buy right now. That right there is the painful real-world cost of an EV miscalculation. And you can literally see the bruises from that amputation right here. Their operating result dropped from 6.7 billion euros in the first half of 2025 down to 5.9 billion in 2026. The operating return on sales, that shrank from 4.2% down to 3.8%. They were heavily squeezed by that US ID.4 production halt, alongside some nasty US import tariffs and those negative mix effects we just talked about. Let's rapidly map out their vital signs to get the full picture. The absolute standout number here is their fortress-like net liquidity in the automotive division, an incredibly solid 32.7 billion euros. That cash armor is basically shielding them from a nasty drop in net income, which fell by 1.4 billion, landing at 3.1 billion euros. Meanwhile, their market cap is just bouncing all over the place on the DAX, highly volatile thanks to broader geopolitical fears and, of course, the big AI boom tech rotation. Bottom line, they have the cash, but the earnings are under heavy attack. Which brings us to Section 4, sector and competitor landscape. Because to truly gauge if this is a value trap, we have to compare VW's internal struggles against the shifting tectonic plates of the entire global auto sector. The whole EV narrative is kind of fracturing right now. Volkswagen saw a painful 5.8% drop in global deliveries of all-electric vehicles, landing at 438,000 units. But wait, here's the context. The overall EV market is declining. With state subsidies vanishing, like we definitely saw in the US, consumer demand is actively pivoting. The data clearly shows buyers are moving away from outright purchasing pure EVs because of the high sticker prices. Instead, they're leaning heavily into leasing, flexible models, and traditional financing. Ironically, VW's financial services division is actually booming because of this shift, even as the EV metal itself just sits on the lot.
So that brings us to our final provocative thought. You have a legacy titan with dropping EV sales, facing a €500 million write-off on a failed US production strategy. But on the flip side, they also have nearly €33 billion in automotive liquidity, an impending €7.4 billion windfall from Everent, and a massive forward-looking stake in Rivian's future tech. So I leave it to you. Do these massive cash reserves and aggressive tech investments make the stock a coiled spring, just ready to snap back? Or does the bleeding in legacy EV production make it the ultimate value trap? Thanks for joining me on this explainer, guys. Keep your eyes on the data.